I would like to welcome you all on behalf of State Bank of India to the conference call. Today on the call from SBI we have Chairman Mr. Rajneesh Kumar, MD Corporate Global Banking and Stressed Asset Resolution Group Mr. B. Sriram, MD Retail and Digital Banking Mr. Praveen Kumar Gupta, MD Risk IT and Subsidiaries Mr. Dinesh Kumar Khara, DMD and CFO Ms. Anshula Kant. We also have all the DMDs heading various verticals present to enable us to answer your questions satisfactorily. Before we commence the call, I would like to read out the safe harbor statement. Certain statements on this call may be forward-looking statements. These statements are based on management's current expectations and are subject to uncertainty and changes in circumstances. Actual outcomes may differ materially from those included in these statements due to a variety of factors. Thank you. Now I request Chairman to give his opening remarks on the Q3FY18 results and the strategies of the bank going forward. After that, we'll open the conference to the Q&A session.
Good evening to all of you and welcome to this conference call. The results and the presentation, I presume, will be in your hands. And during the quarter, there has been a loss of 2,416 crore. And this loss is on account of two major factors. One is the hardening of yields, which has impacted the profit by way of mark-to-market by 3,400 crore. That is, of course, below the line, and above the line, the impact is about 2,000 crore. In the last quarter, the income was 3,000 crore. This quarter, it has been 1,000 crore. Another factor is that many accounts which were in the stressed assets, they have now been classified as NPA during this quarter and provided for. The combined impact is all before you. And if I look at the stressed assets or the NPA, the slippages as compared to the previous year, they are much lower. So they are elevated, but still at the much lower level. And that is the trend which I am seeing going forward. The situation as far as the stressed assets is concerned is going to improve. And next year in 2019, our estimate is that the slippage will not exceed 2% and credit cost also is going to be within the range of 2%. There has been very marginal, of course, improvement in the NIM, and that has to be taken into consideration that when account gets declared as NPA, some interest reversal also happens. Other income, again, if we remove the impact of the treasury and the income coming from the sale of investments, the other income is quite steady. In fact, bank is doing very well as far as other income is concerned, be it government business, be it the payment space, be it the cross-sell or recovery in the written off accounts. Overheads are very much under control. Staff costs are in fact down. As compared to March, the number of people have come down by almost 13,000, and a lot of optimization of costs. And in the post-merger scenario, the rationalization of branch network, the centralized processing cells, the currency chest. So a lot of work has been done, and its impact will be visible in the coming quarters and months. So this quarter is, of course, it is a disappointing quarter for us also, but every cloud has a silver lining. And going forward, what is visible is that financial year 2019 onwards, the normalcy as far as the NPA or the credit costs is concerned, that will return. Bank subsidiaries are doing exceedingly well, and it is our hope that they will continue to do very well, and they have grown their market share, they have improved their profits, and they bring a lot of value as far as the bank is concerned. On the digital front and the payment front, bank has established a very clear leadership on account of the investment in technology, which bank has been consistently making over the years. And whatever field we take, whether it is a debit card or debit card is spent, or merchant acquisition business, payment transactions, the share is 30% and above. Even our business correspondent channel, which is handling largely the financial inclusion accounts, it is now on the verge of becoming a break-even as of now, but within next 6 months, it may be become a very profitable channel. So on the whole, accepting this quarter's performance, but things are very much looking up for the bank and very much under control. So these are some of my opening remarks, but please feel free to raise whatever questions you have, and we'll try to answer to the best of our ability.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. We will take the first question from the line of Mehruk Adajania from IDFC Securities. Please go ahead.
Good evening.
Good evening.
Good evening, sir. So, one is that on your divergence-related slippage, the power was a key sector. So, what would be the size of the largest 2 accounts?
The size of the 2 largest accounts?
Around 3,600 crores each.
Each, okay. And my other question is that what would be your cutoff yield on the GSEC book?
Cutoff yield is 7.32.
7.32. Okay. Okay, sir. Thank you.
Thank you. We will take the next question from the line of Mayank from Goldman Sachs. Please go ahead.
Sir, good evening. This is Rahul here from Goldman Sachs. Just 2 quick questions. Number 1, can we get the number of the total stress asset pool excluding overlaps as of last quarter? So this quarter is 50,000.
No.
Last quarter, September quarter.
See, Mahesh flagged this to me that you may want this. We don't have the exact number for that 525, but one number I can definitely share with you. If you see our slide 7 where we have said that 19,394 crores has slipped from the stressed pool.
Yeah.
So about 10,000 has come from standard restructured in this, and another 10,000 has come from S4A and SDR, and
maybe you can give it
then there is another 10,000 in watch list, and then there is around 2,000 in 525, but there is an overlap of about 13,000 crores.
This 13,000 crore overlap you're talking about is of previous quarter?
No, this is about the slippage. See, if you see our slide 7, 19,394 crores.
Yeah.
The extent of 90% has come from one or the other of these stress pools.
No, correct. But actually what I'm trying to get to is, if I look at the total stress pool, excluding the overlaps, how has that changed?
Rahul, we don't have it at the moment. Maybe
Right.
we can give it to you.
Sure. The other question
What I'm trying to highlight, Rahul, here is that it is at 2.60%. Everything put together today is at 2.60%. If you add it up to the gross NPA, it is still below 13%.
Sure. The other question I had was on your guidance with regards to slippages in next year. So you've guided for about 2% slippage ratio.
Yeah.
So if I do some rough cut calculation, it comes to about 40,000 crores.
Very right.
Now, within that, there would of course be some regular, run rate of slippages coming out of retail, SME, and agriculture.
All taken into account.
Okay, so the corporate slippages would be what, about 25 to 30,000 crores odd number?
Maximum.
Retail is about 4,000 every quarter.
4,000 crores is the gross slippage, but net increase is always less than that. So basically, I think you are very much on the dot that maybe about 10 to 12 for retail and between 25 to 30 for the corporates. And that is, again, I would say, a very conservative scenario. Things could be better, but still don't want to give any high hopes, and that's why I'm giving the number within that range.
So this essentially is 50% of our total stress pool as of today. So which means that, are we seeing encouraging signs of NPL resolution on the other 50%?
Right. So this is the fresh slippages. This is not the overall reduction in the NPA. So we have to distinguish between that.
No,
Because
correct.
your NCLT list, 78,000 crore, that is going out of NPA list.
Now, there are two things, Rahul. One is, of course, we'll have to factor in a Q4 performance as well, number one. And now, the second thing is that of these 525, there are quite a few which have, maybe put under the stress category, but may not really
Turn into NPA.
Okay.
I think the key point here is that you have to look at 5 quarters.
Yeah.
There
So
is a
fourth
fourth
quarter we are
quarter
not talking.
still happening. We are talking about 2% slippage next year.
All right. Got it. Sure, ma'am. Thank you so much.
Thank you. We will take the next question from the line of Adarsh Parasrampuria from Nomura. Please go ahead.
Hi, sir. So first question is regarding the 525 book, right? Can you just, this is one part of the book which is still large, which is the non-NPA stress. Can you just qualitatively talk about the book? What kind of names you actually don't think is stressed? What we are trying to figure out is you have a 50,000 crore net.
Right.
So just qualitatively, can you talk about sectors and names where you think eventually you will not lose money in some of these accounts?
So mostly these are infrastructure, and in infrastructure our maximum exposure is in power sector. So 5 by 25, yes, I have always maintained that 5 by 25 does not necessarily mean a stress asset. It was an alignment of the repayment capacity based on the cash flows of an entity. So if you look at the sector wise, we now, even in this quarter, a large chunk is coming from the power sector. And going forward also in next 2 quarters, this will be the power sector alone, and rest is all, we have a large portfolio, so normal slippages. For a bank which has the balance sheet advances portfolio of almost now 20 lakh crore by March end, which is what we are expecting. Okay, about 9,000 crore per quarter, which comes to 2%, is something which is considered to be very, very manageable, and it takes care of all type of assets.
Understood. And sir, just going back to our first quarter, we had a lot of slippage. A lot of those were smaller accounts.
Right.
We've not seen a material pickup in the recovery. There's some pickup, but not a material pickup in the recovery and upgrade. And now we've already got the SME, NPA classification, relaxation. So how should one think about it in agri, retail, SME put together? Are those accounts coming back or they are permanently slipping?
One is that 56,000 crore is at the end of June quarter. Yeah. We are now at 50,800 crore odd as far as the retail is concerned, which is agri, SME and this thing. Within agri also, what we have to keep in mind is that 2 geographies, Maharashtra and Karnataka, they have very high agriculture NPAs because of the dead waiver, drought and all those considerations. If I exclude these 2 states, in fact our agricultural NPA performance has improved considerably, and in a post-merger scenario we are at around 7.5 or 7.6%. As far as the retail book is concerned, there has been a considerable improvement as far as the percentage NPAs are concerned. SME also there is improvement, but still the percentage continues to be high. But that was one of the reasons was that also that the denominator was not growing. But now the denominator has started growing, and we have put a lot of emphasis on changing the portfolio in SME and in agriculture also, where the emphasis is on what we call the risk mitigated products. And even for the balance sheet financing in SME, we had initiated a project almost 2 years ago, and that is giving us very good results. And all the changes which government and Reserve Bank of India has now made as far as SME is concerned, so going forward, I see that there will be a good growth in SME segment. Bank is fully geared up to meet and cater to the requirement of MSMEs, and we are very confident of managing the asset quality as far as retail is concerned.
So the guidance in the first quarter, right, that you'll recover like 50% of that 22,000 crores that slipped, still holds good. Is that got delayed or?
No, already achieved that. I think our indication was that by March end we will be at around 50,000 crore as against 56.
Okay. And so
may we request you to come back in queue for follow-up questions? Thank you. Participants are requested to limit their questions to 2 per participant. You may come back in the queue for a follow-up. We have the next question from Kamal Verma from CLSA. Please go ahead.
Good evening, sir. This is Prakhar. Just a couple of questions. One, this divergence report seems to be on the parent bank itself. Would there be a divergence analysis on the subsidiary banks also?
Not too much. Hardly any. It got merged. So 31st March was SBI solo.
And you know what? Yeah, I want to say this, Prakhar, that 31st March was SBI solo. But whatever the observations are there, we have taken it across the bank as on 31st December. So,
Okay.
if the account outstanding had increased because of merger, we've done
so that has all been classified.
If
Yes.
there is a reversal on the fixed asset revaluation partial, we've done it across whatever. So it is taken care of now.
Got it, ma'am. And ma'am, also this the NPL that you have recognized out of the watch list or the SDR or 525. In your view, would these be NPLs with most banks already, or you would be ahead of the market in terms of classifying them as NPL?
I think because the way RBI now is doing AQR or this thing, there is likelihood that most of the banks would be classifying. But there may be some bank where if RBI has not told them to classify, they may not have classified. So I don't have any definite information as far as this question is concerned.
Perfect. Quickly, sir, the slippage outlook that you are discussing, should we assume that the next 5 quarters slippages should be largely smoother in trajectory, or there could be some bunching up in the fourth quarter and next year we'll see more smoother normalized level of slippages?
The 90 days is always a very tricky thing. So it's very difficult to say that if it is say 50,000 crore, so every quarter it will be 10. So to that extent, some variance may be there, but quarter 4 will be less than quarter 3. So that is one thing which I can definitely state. And the FY19 already we have given some guidance. So the overall pool is what you can easily calculate and arrive at. Now within the quarters there can still be some variations, and that cannot be helped.
Thank you. We will take the next question from the line of Manish Karwa from Deutsche Bank. Please go ahead.
Yeah, hi, good evening, sir.
Good evening.
It seems there's a lot of interest reversals during the quarter.
Manish, you're not audible. You need to be a little loud.
Yeah, hi, is this better?
Yes,
Yeah.
thank you.
Yeah. It seems there's a lot of interest reversals during the quarter. Is there a quantifiable number for that?
We can come back to you on that number.
Just give me 5 minutes, I'll come back to you.
Okay, and the divergence thing, would it be fair to assume that all the divergence are now NPL by
The
December?
divergence is about NPL. So the divergence is where the supervisors feel that as on March 31, 2017, these accounts should have been in NPL.
No, what I'm asking is that have they already been classified as an NPL now by till this?
In December, yes, everything.
Okay, and on the capital thing, you mentioned that you will need to raise 20,000 crores from the market, and this is in addition to what our government will give you in the recap, the second round of recapitalization.
So second round of recap, there is no firm indication from the government, and we are not relying on that also. So 8,800 crore I get this year, and as a part of MOU with the government, we will raise 20,000 crore from from the investors market, depending upon the timing and from whom and in what manner, that we will decide. But this 20,000 crore is other than the government.
Okay. And last, a small one. You said that you have provided on the treasury line up to 7.32% 10-year GSEC yield.
Yes, yes.
On top of that, if the yields are higher by 31st of March, you may still need more provisions to be made.
Yes.
Okay. Okay. Thank you so much.
It depends on the portfolio and the modified duration. I think you
but
are aware
still
of
some
that.
provision.
Yeah.
Sure. Yep.
Thank you. We will take the next question from the line of Manish Agarwal from Phillip Capital. Please go ahead.
Yeah. Sir, have you utilized RBI dispensation for MSME classification this quarter?
No, not at all. It has come only now, and we really don't know. First, I will have to get all the data about like who is GST registered, not registered. So that is a very complicated exercise according to me. But if any benefit comes, it will come in the March quarter.
Okay. And second is about the power portfolio. Now, have we accounted the under construction power portfolio in our watch list or any RBI dispensation category?
Look, like whatever has been classified, quite a few of them are under construction projects. So that is very much there. It's already classified.
So, would it be possible for you to quantify what are the under construction stalled projects for us? Exposure to under construction stalled project?
Yes.
There are 8 under implementation projects which have been classified as NPA.
Okay.
And there are 3 more projects which are still standard.
Can we have the exposures?
Consolidated exposure, I will.
Yeah, we can add up the number and give you.
Yeah.
Okay. And finally, one last question on the telecom exposure, which was on the watch list, which slipped during the quarter. So, is the same exposure which will be upgraded maybe subsequently because of some management change?
Yes, we are very, very hopeful, and within March quarter, this should get upgraded.
Okay. Thanks. Thank you, sir.
Thank you. We will take the next question from the line of Anand Latta from HDFC Mutual Fund. Please go ahead.
Hello, sir.
Yeah.
Just want to understand, so of the divergence of 22,000 odd crore rupee, how much was recognized as NPA in Q1 and Q2, sir? And how much has
2,200 crore.
Sorry, how?
2,800 crore.
Okay.
And Q2 nothing, and then rest is all in Q3.
And in Q3 we had a 19% upgrade also.
Yeah. One account got upgraded, 4,300
crores got upgraded in Q3.
So this 4,000 crore upgrade is a part of your slippages and part of recovery, or it's not?
March 17 it is in divergence.
Okay.
And December quarter it is upgraded.
Okay.
So you classify within the quarter and upgrade within the quarter.
So actually, but if you see our movement of NPA, because it happened in Q3, we have not shown it either as slippage or upgrade.
Okay. So we also have seen large slippages on the SDR book. So if you can give some color, we have outstanding SDR book of 5,000 odd crore rupees still. What proportion of that will complete 18 months period next quarter or in Q1?
Whatever estimate, broadly what I have given for 2%, which comes to about 40,000 crore, it includes all and everything.
Okay. So if I remember at the start of the year, we had a slippages target of 60,000 crore rupee. I believe we would be crossing that target very significantly this year.
We are at right now
61,000 crore.
61,000 crore already. So you are right that to that extent, yes, we will slip. But when I compare with 1,15,932 crore of last year, so we will be much below that.
I agree, sir. So we always thought that 1,19,000 as against that, it should have been significantly lower.
Significantly lower, but significantly has to be quantified.
See, the thing is, whatever, if you think about it 2 years back, nobody thought that the stress in the economy would play out for so long. Underutilization of capacity, low demand. That is why it is, things have not turned around as per expectation.
Yeah, and particularly power sector, we ourselves are a bit disappointed that in a country where there is so much power deficiency, but because of the inability of discoms, and they're not coming out of PPA. So that is impacting and putting pressure on the power sector assets, but otherwise fundamentally they are top quality assets, physical terms.
Right. So just want to understand, sir, we used to carry some floating provision. If you can give some color, like how much we have utilized in this quarter, and so we still carry some provision of 6,000 crore of floatation. So is it the floating provision against specific exposure, or what is our thought on this, sir?
So floating provision, we have not taken any write back or anything.
We have counter-cyclical provision buffer of 1,250 crores.
That remains there.
That remains, and the stress standard asset provision, on various accounts has built up over time to 5,600 odd crores. Some of it got actually reversed also because some accounts from this, when they moved to NPA, the provision moved along to the loan loss provision.
Okay. And so lastly, have you made any provision on the employee side on the wage negotiations?
Yes, for 2 months, 700 crore almost 660, 700 crore for 2 months.
Okay, so 660 crore is what you have made in this quarter.
Yes.
So this will be part of the employee salary cost, not in the employee contribution line.
It's partially there and it is partially there. So the salary portion provision comes in the salary and the other portion comes in
whatever you provide for
contribution.
terminal benefits, that will come in contribution.
Okay. And so lastly, we also we changed the revaluation of some of our assets. So what has happened that we revalued back to normal valuation?
See, last year RBI had allowed revaluation of fixed assets, if you recall.
Right.
With a 55% haircut, you could take 45% into a CT1.
Right.
And when RBI saw our books, they suggested that the leased assets had revalued because they were fully marketable. But RBI suggested that we should not revalue and take that portion into capital. So that amounted to roughly 10,000-11,000 crores. So that we have reversed, and accordingly about 4,500 odd crores has come out of our CET1 on account of that. And there has been a recoupment of depreciation accordingly of about 300 crores.
Fine, ma'am. Thank you.
Thank you. We will take the next question from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, good evening, sir.
Good evening.
I think I would request actually Anshula ma'am to, if you can, post merger, if you can just give the next 3 quarters of what the total stress, like we have put out in the current presentation, and it'll just boost our confidence that the bank is kind of moving in the right direction.
So we'll try, and I'm not sure whether we'll be able to pull out the numbers for June because there was a lot of chaos at that time. But September, I'll try and we'll give it to you.
Sure. The second question, sir, is on the fee side. Could you quantify, what percentage is retail and how are we doing on the retail fee, sir?
Retail, we are doing extremely well, I would say. And
we'll pull it out. That number we have somewhere. We'll pull it out and just.
So that number also is share. But as I said, that whether it is commission on government business, whether it is commission on the cross-sell, recovery in return of accounts, even a portion of the forex income comes from retail, and recovery of charges, commission on collection, locker, rent, etc. So just to give you an idea, say for example commission on government business, Q3 last year it was 661 crore, now it is 840 crore. If I look at the 9-month period, 2,400 crore versus 2,100 crore. Then cross-selling, 1,074 crore versus 579 crore. Miscellaneous commissions, etc., 8,336 crore versus 6,532 crore. So that is what I have been indicating, that as far as the fee income is concerned, and particularly on the retail side, which is a very diversified source of income, we are doing extremely well on that front.
Okay. When I look at the slippages for this quarter, right? So if I exclude, that the portion which came out because of the divergence, about 19 odd thousand crores. So if the balance, which is about 6,000 odd crore, is what has been historically, a run rate going back, I think, almost 4 to 5 years.
Yes.
But on these slippages, most likely we were not earning anything at all, because most of it is probably coming out of those schemes where RBI has already disallowed accrual of interest. And therefore, when I look at the margins, it doesn't look like it has, it has kind of remained largely flat, maybe 4 or 5 basis points higher sequentially.
Right.
And given where, how interest rate trajectory is moving up, how do you foresee margins going forward? Or are we going to kind of lag around or languish around these levels?
No, I'll just take the first part of your question, the sense that, some of these slippages actually were earning, many of these accounts are earning interest. And it's only the under implementation power accounts which were not. And many of them were earning. So that income
got reversed.
Got reversed, and till the time that we resolve them. As we just said, that one of them actually was flipped and then got upgraded as well the same quarter. So
right, sir.
We are not loss of income there in some way. So that portion, I think there is interest income was being earned.
But interest reversal in 9-month period has been 6,370 crore, and quarter 3 it has been to the extent of 1,910 crore. So when the account becomes NPA, definitely it pulls down the NIM.
Okay.
But as we see the situation, as the NCLT cases start getting resolved, and even if it is a 40% recovery, so on that we will start earning income.
Right. Okay.
And our expectation, of course, March 18 is relatively stable wherever we are, or maybe a little bit upside. But next year we are definitely expecting 25 to 30 basis point improvement.
Okay. That's excellent, ma'am. Thank you so much.
Thank you. We will take the next question from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah. So if you can give some more granular breakup of the power sector in terms of how much of the power is currently there in GNPLs, 525 and other restructured, post this entire classification of divergence as well.
Already classified.
I have some numbers. If that will help, see, total power sector exposure was 1,67,000 crores.
Yeah.
Out of that, about 21,000 crores plus has become NPA. Okay. Now we have remaining about 1,46,000 crores. Out of that, about, then there are overlaps. I'll come to the overlaps. About 34,000 crores are sitting either in 525, S4A, SDR, standard restructured or watch list. 34,000.
34. Okay.
Yes. And the assessment is that there is another 6,000 odd crores where there are some operational issues which are not in these pools. But other than that, the portfolio is
all the AAA, AA,
public sector, etc.
Okay. So within this, maybe below investment grade, there would be nothing left out if we are considering this 6,000.
Yes, overlap agar le lenge to. Yeah.
Okay. And so overlap, so between this, there would there be an overlap? So 34,000 is
so 34,000 is after netting off the overlap of about 7,600. So it is after that. So 34,000 is after overlap. It's the net amount.
Okay. And 525, any color on this out of this 34,000 crores?
It is out of the 24,000, 90% plus is in power.
Okay, out of the 25,000 crores of 525, 90%.
All this, what I'm saying, 34,000, most of it is in 525 actually.
Okay. And secondly, in terms of this impact of Ind AS, whenever it gets applicable, so not sure in terms of the applicability, but if we look at it that now the larger part of stress is also getting recognized, so stage 3 maybe given what provisioning is required, or even in stage 2 given the expected credit loss, Any estimate as to how much can be the impact on the overall net
So
worth?
we keep on calculating in quarter-on-quarter basis and share with Reserve Bank of India.
Yeah.
We have to probably wait for the guidelines, because unless the final guidelines come, it is very difficult to make a guess. But yeah, Anshul, I want to
See, what is happening is, as each quarter passes by, the impact on if we move over to India is actually coming down. Because, these are the pools of stress which are now getting classified as NPA. The NPA provision cover is going up. That is what is reducing the impact of the Ind-AS. And in fact, if we get the transition period of 5 years, which is likely whenever we cut over, I don't think it will be such a significant impact for each year that it will be very material anymore.
Secondly, at this point of time, we don't know what the guidelines would be, what kind of provisioning
We
would be
don't
required.
know, but broadly, sir, whatever assessment we have done, our PCR without OCA is at 48-49% now.
I mean, at this point of time.
So it is not much beyond that.
Okay. Okay. And lastly, if you look at the total stress and the GNPLs, outside of this, how much would be, say, below investment grade exposure which would be left out across the sectors? So if we consider 50,000 of the stress pool plus maybe the GNPLs, outside of this, what would be the below investment grade?
No, I think we can't obviously say that below investment grade would be stressed. There's quite a.
Yeah, no, just wanted to get maybe.
No, I
have that. We will no, separately. Maybe you can ask the department. We'll let you know separately, please.
Yeah, not a problem. Yeah, thank you.
Thank you. We will take the next question from the line of Lalita from Sharekhan Limited. Please go ahead.
Yeah, thanks. My questions have been answered.
Thank you. We'll take the next question from the line of S. Parmeshwar from JM Financial. Please go ahead.
Yeah, thanks. My question has also been answered. Yeah.
Thank you. We have next question from Mehruk Ajania from IDFC Securities.
Yeah, hi. Just wanted to check that in terms of your core fees, have you reversed any income on minimum balance?
No,
because there were some news articles.
We haven't reversed anything. We reduced our minimum balance charges from October. So this quarter, our income has been lesser on that account actually.
Okay. But there has been no reversal of the past income, now, because some press articles were alluding to that.
There has been no reversal.
Okay, and I'll just add, I think there was a question on how much is retail and how much is non-retail fee income. About 76% in this 9 months is retail fee.
Okay. And so just one more question, that earlier you used to share a slide on gross slippages segment-wise, like SME, retail, personal.
We can still.
Would you be able to share
I can give you the numbers.
Yes, yes.
Okay, so.
PAG is 13,724.
Sorry?
PAG, corporate accounts, with large corporates, 13,724.
Sorry, how much?
13,724.
Thank you, sir.
You want all, or you just?
Yes, all. Personal.
Mid corporates is 7,730.
Okay.
IBG 369 crores. And agriculture is 1,564 crores. SME is 1,977 crores and PER is 472 crores. Those three numbers which are said in the end are actually given in the first couple of slides also. Corporate we have clubbed together.
Okay, perfect. Thanks so much. Thanks a lot.
Thank you. We will take the next question from the line of Sri Shankar R from Prabhudas Lilladher. Please go ahead.
Most of my questions have answered, but one quick question. You have shown your standard restructured levels at around 50,000 crores. So we were mentioning about the power sector at 34,000 under SDR 525, etc. 34 plus 6. This is forming a part of that 50,000?
Yes, very much so.
Okay, thank you.
Thank you. The next question is from the line of Prakhar from CLSA. Please go ahead.
Thank you for taking my follow-up question. Just wanted to understand, 12 months from, currently your advance growth is running at about 3% on a YOY basis, post on a merged basis. When do you think we will start seeing at par, growth in terms of advances? Maybe it's an issue with the, book realignment between bank and subsidiaries, but when will we get back to sector average growth rates?
But we are seeing credit growth. There are signs of pickup, and last quarter, in any case, a lot of disbursements are there.
Okay.
And retail book is growing at the pace at which we want it to grow. And corporate also, hopefully that...
There is a swing between the markets and the loan book in corporates. If you see, even this quarter, by this time, almost 20,000 crores worth of CPs have been taken.
Yes.
So it doesn't matter to us as we have realigned our portfolio, whether the growth happens in the loan or the market.
And corporate book going forward, more and more it will be in the CP and bond market.
I'm saying basically that whether we'll grow in alignment with the market, I think from next year that...
no, we will grow at 10% because my balance sheet size is 19.5 lakh crore. So I can't grow at 20 or 25%. So there we are very clear that for us 10% growth means almost 2 lakh crore. So I won't dare to go beyond that. Let me put it this way.
No, thank you. And Anshula ma'am, you had just clarified that you have certain provisions outside the NPL provisions, and some of it might have been used. Would you have the stock of the provisions for counter-cyclical and those stress total put together?
Is there on the presentation 1250 crores counter-cyclical?
Oh, sorry. Sorry to have missed it. I'm sorry, embarrassed for that. And lastly, sir, when the wage hike provisioning that you've done, what is the basic assumption on the extent of wage hike that you are as of now building in terms of the provisioning levels?
10%.
10%. So that's actually much lower than what we saw last year. And would this also be...
The number of employees has gone down substantially. Between April and now, the number has come down by 13,000, and this number every month, 1,000 people are retiring. So that's how all these estimations have been done. But Prashant, my CDO is here. Do you want to add anything else?
Basically, in the present environment, even 10% is very optimistic, because this is the industry level wage settlement, and most of the banks are under stress. And going forward, if there is a better prospect, then we'll make that decision.
And is this based on all the employees as the case was last year, or this time it is being considered that below a particular grade, only they will get a wage hike and others will probably be based on...
For everybody. It doesn't happen in the bank. We may have said that we will negotiate only up to skill 3, but when the wage hike happens, it happens for everyone.
Thank you very much, sir.
Thank you. We will take the next question from the line of Roshan Chutki from ICICI Prudential Asset Management. Please go ahead.
Thanks for taking my question, sir. At a system level, on LCR particularly, the requirement of 90% is applicable from January 1st. Is that right?
Yeah. Yes, correct. And we are much above that.
Yeah. That needs to be adhered on a daily average basis, right?
That's right.
Yes.
So if a bank has less than, say, 85%, is that as of December 31st, that's a problematic situation. I mean, regulator will...
Where did you get 85%? I believe we are more than 100%.
We are much above 100%, and we...
130.
So we are at close to 140%, and it is being monitored from the system on a daily basis. We have implemented something called Oracle Financial Services Analytical Software.
Sure.
It gives us a daily position.
Right.
More related to the system, not related to SBI in particular.
Okay. No, I'm talking about SBI.
Sure.
And we are much above that and would like to, in fact, bring down it a little bit.
Sure. And another question is on the retail assets front. Are you seeing any incipient signs of worry at all on the asset quality of the retail assets?
No, not at all, because the numbers are before you. Gross slippage is 4,000 crore, which is in line what happens quarter after quarter, and there is in fact a net reduction because recoveries, upgrades, some write-offs also are there. So that will like retail book of 9.5 lakh crore. It is very, very steady. and the lending practices also. Lot of steps we have taken to risk mitigate agriculture and SME portfolio. Rest of the portfolio, housing loan, personal, express credit, all that in any case the bank is very careful in terms of either LTV or linked to the income or cash flow. So we have no worry as far as the retail segment goes. Yeah, Anshula.
See, I just want to also highlight for everyone that under every product in retail, there has been a sequential reduction. Home loan has come down by 10 basis point. Home loan NPA, auto loan has come down from 1.45 to 1.36. Overall, it has come down to 1.33. If you see in SME segment, the NPA has come down from 10.91 to 9.20. Even in the agriculture, had the denominator not got reduced by around 7,000 crores due to debt waiver, and plus the fact that two outlier circles are there, our NPA would have been below 7% if it had not been for that debt waiver. So I think on the retail and agri and SME, we are fairly comfortable.
Thanks. And it is borne out by the vintage curve analysis as well, I presume.
Borne out by?
The vintage curve analysis, as in based on sourcing, say, a loan has been sourced in a particular year, how has performance been?
Yes.
Sure. Thank you so much, ma'am. All the best.
Thank you. All the best to you as well.
Thank you. We will take the next question from the line of Ravi Singh from Ambit Capital. Please go ahead.
Sir, related to earlier question on the loan growth, in recent budget, government has discussed a proposal to ask SEBI to ask large corporate taking 1/4 of their borrowing from the market, and there was this earlier proposal from the RBI to ask eventually companies with more than 10,000 crore exposure, 50% incrementally coming from the corporate bond markets. So what is your view on the opportunity on the corporate loan growth, given that how the rules are shaping on that side? And given even if you are able to capture market share on the CP bond markets, I think profitability there will be much lower. So any strategy to offset pressure on the large corporate to build your market share in the mid corporate or SME and retail? What are you thinking about the entire dynamics?
So as far as corporate book is concerned, this is inevitable that movement will happen from loans to bond or CP market, and the yield will be much lower, but at the same time the risk will also improve, because when you go to the bond market, the risk recognition happens very fast. So it is not that it is some sort of a huge negative impact. Ultimately, when you look at the income also, you have to look what are the credit costs, and when the market instrument not everybody will be able to access, even if it is A and above, then the yield may be lower than the loan book, but still we are not as much worried about it. It is a good development, and as far as the loan book is concerned, more and more emphasis is on the retail, which includes our SME also, and corporates. The lending will be selective at, I should say, on our terms, on our pricing, and high quality exposures. That is what the effort would be.
Actually, there is a small issue on the corporates going into markets, in the sense that today there is no demand for lower rated corporates, in the sense that if you are lower than AA, the demand is not there. And if the demand is there, the pricing is too high for those corporates to sustain. So if you have say for example a BBB corporate, if you go to the market, if at all there is a buyer, he will charge 13, 14, 15% for that. So it's not only a question of directing companies to go into areas other than bank loans and the source, but also there needs to be development of those enablers there. The second thing is that as I said, the comfort to the banks is actually when there is a day's default and there are triggers, and it doesn't happen in the loan book because there is a cushion period available to rectify the defect. So in that sense, as bankers or as regulators or as even as the government, we would surely like to go as much as into the markets. But again, it all depends on how fast it is developed.
Thank you, sir. Sir, any qualitative sense what percentage of corporate loan book would be towards corporate with 10,000 crore total borrowing from the system?
No, but 10,000 crore comes 2 years later. Right now, from next year, it will be
25,000
crore. Okay, so it's a 3-year transition period for that.
But 25,000 crore and above are all AAA, public sector undertakings, Maharatna, Navratna, likes of Tata. So those kind of exposures. 25,000 crore is not everybody's book.
Okay, thank you, sir.
Thank you. We will take the next question from the line of Anand Laddha from HDFC Mutual Fund. Please go ahead.
Sir, like you just indicated that next year looking at 10% credit growth. So if you wanted to break up your credit book into retail, SME, agri, what sort of growth in each of the segment you are looking next year, sir?
So we are at 60% now of the domestic book. So we would try to maintain that 60% remains. So if it is a 2 lakh crore growth, 1,20,000 crore will be the target for the retail book.
Okay. But sir, in that case, if I have to look at the industry on the retail SME side is growing much faster. So we would be at least won't be able to grow in line with the industry also, sir. Like retail, we have grown at 14%. If I look at each of the element of the retail, our growth has been slower than the industry growth, sir.
Right, but it is a base effect also. My base is very large. That is what I also keep on saying, that a bank which has a total loan book of say 1,50,000 crore, 2 lakh crore, they can afford to grow at 20-25%. But SBI, our market share, we are able to maintain with whatever in percentage term appears to be a lower growth. But fact of the matter is that whether it is home loan, auto loan, everywhere either we have improved the market share which was already high. And that's why that percentage terms become sometimes misleading. In home loans, our market share now is 33%. So I can't make it 40%. 33 may become 34 at best, but it will remain in that range. And auto loans we have improved by how much market share? Almost I think 200-300 basis points. So that is the limitation of the market size also. And when you compare the credit growth of some of the private sector banks, that is credit card is included in that.
Okay. Sir, we are seeing some green shoot in SME this quarter. Do you expect this growth to improve meaningfully next year?
I think the emphasis which now even government is placing on MSME and the formalization, that is very important, that a large chunk of MSME was not ME, but MSE was definitely outside the formal lending borrowing markets. And now because they are all either have to be GST compliant, impact of demonetization, so that will open up a lot of opportunities for the banks to lend to MSME, and for us it is a focus area, and I am very, very hopeful that we'll do well in the coming year as far as SME is concerned.
Right. So what is our CD ratio currently, sir?
That's
It is 65.97.
Almost 66%.
The incremental during the quarter has improved.
That was 140 basis.
140%.
Okay.
So credit growth has been higher than the deposit growth.
Okay. Thank you, sir.
Thank you. In the interest of time, participants are requested to limit their questions to one per participant. Thank you. We will take the next question from the line of Nishant Shah from Macquarie. Please go ahead.
Hi, sir. Just one very quick question. The industry-wide telecom exporter which has slipped during the quarter. Could you quantify the amount of exposure that you had to it?
2,600 crore.
2,600. Yeah. And was this a part of your divergence?
Yes.
Okay. And if I can just squeeze in one more quick question, what is the percentage of your floating rate book which is still on base rate or yet to move to MCLR?
Of the performing loans, 14% are still on base rate, 1/4.
still on base rate. Okay. That's it.
And as this quarter, as the review renewals are at the peak in the fourth quarter, we are expecting this percentage to come down significantly by March itself.
Okay. That's it from me. Thank you so much.
In the interest of time, we'll take one last question from the line of Abhishek Singh from Birla Sun Life Insurance. Please go ahead.
Hello. Yeah, sir, this is Sandeep.
Yes.
Just one clarification. This 5,600 crore of stress asset provision, it is a part of cumulative loan loss provision or it is over and above that?
No, it is over and above that. Loan loss provision is purely for NPAs.
So the PCR which we calculate, it is not included in it?
No, it's not included.
Okay. Thank you, sir.
Thank you. We'll take one last question from the line of Dhaval Gala from Birla Sun Life Mutual Fund. Please go ahead.
Hello.
Yeah.
Thanks for the opportunity, sir. Just a question. I think you answered about your loan growth expectations. One has to assume, if at all, IFRS has to be implemented either in the immediate start of the financial year, next financial year, or maybe the following financial year. Could you expect that the capital needs for SBI would be higher or lower? Or the 20,000 crores number, does that include everything? And if at all our growth expectations are not so high, and assuming that the profitability wise we should return to a much better number next year because your expectation on slippage is 2%, credit cost is 2%, then why do we need to raise capital next year?
No, we have certain calculations of about growth in risk-weighted assets. And IFRS right now we are not taking into account because we don't know how much transition period will be allowed, what will be the rules. So that is something we are leaving it open as of now. But 20,000 crore is something which we may need next year, and that's why it has been planned. And
if I may say, today our tier 1 is at 10.30. And by March 19, regulations prescribe that our tier 1 should be at 10.10.
And you'd like
so there
to
is very
be over
little
and
room or cushion for growth between 10.30 and 10.10. And definitely for a bank of our size, we would like to be at least 50 basis points above minimum threshold or more. So, and this is not the only avenue. We are also going to be looking at divestment of non-core investments, and we may even look at some of the other avenues for raising capital, if required.
But madam, if at all, just to ask you, is that also for perspective that you expect your internal capital generation will be even weaker than your RWA growth even in the next year?
It will be much healthier next year. I think, I don't know, Chairman mentioned in the beginning, we are targeting an ROA of 0.6% by March 19. Ballpark figure. It's not a hard, fast guidance, but we have done our number crunching. We are expecting improvement next year.
Then why should we be why should we be raising capital to that magnitude if at all the number is not considering the IFRS
from the board, and depending upon how does the RWA growth span out, so we will take a call. It is not something that we have decided that we are going to do it next month or this thing, but board approval is there, and in any case that is a MOU requirement with the government for this 8,800 crore infusion. So we will enter into an MOU with the government that we will raise 20,000 crore. But it is better
as the nature of a buffer to enable us to build up growth opportunities, and we need to know
bank
the
would like
size of
to be
this
like I think whatever are the benchmarks, but we would like to be much above the benchmark. We need some safety cushion anyway.
All right, sir. Thanks a lot and all the best.
Okay.
Thank you. Due to time constraints, that was the last question. I now hand the conference over to Chairman for his closing comments.
So thank you very much, everyone. And I think we have had a very wide range of questions, and almost everything has been answered. But going forward, we are going to improve the asset quality. Provisioning requirement will come down. retail franchise for the bank is doing extremely well and will continue to do well. On the digital side, on the payment side, bank has captured more than 30% market share despite so many new players, so much competition in the market. Overheads are very much under control, and there will be a very tight rein on the overhead. The sources of other income, there is a much more thrust on augmenting the same and improving the other income. So on the whole, 2019 onwards, we are expecting that we will be able to deliver much better performance than what has happened in the, I would say, last 2 years, because of the biggest challenge, which was the asset quality. SBI was not alone in this, but yes, because we were the leader in the corporate banking, so that's why the brunt also has been borne by the State Bank of India. But the entire portfolio strategy, pricing strategy, skill upgradation, risk management around credit processes, revamping of commercial banking organizational structure. So everything has been planned that what are we going to do and deliver a superior performance. So thank you very much.
Thank you. Ladies and gentlemen,